Now that we have taken a look at acquiring a fixed asset, depreciating the fixed asset, let's take a look at what needs to be done if we dispose of the asset. The accounting for the disposal of a fixed asset consists of 3 steps. First, if it's necessary, you would need to update the depreciation on that particular asset. In a perfect world, we would sell everything at the end of either the calendar year or a company's fiscal year. For a calendar year, we would sell everything at December 31 or January 1, and then for a fiscal year, it would depend on when the company starts and finishes their fiscal year. But we don't live in a perfect world, so typically we won't have that luxury, and we will have to record depreciation for as long as we've held that asset in that particular year. So if we held it through March, we'd have to do 3 months. If we did April, it would be 4 months if we were working on a calendar year. So the first thing we would need to do is update the depreciation up to the point of sale. We then will calculate a gain or loss on the disposal of that asset, and then we record a journal entry for that disposal. Rules for calculating the gain or loss on a disposal are as follows. If the proceeds from a sale is greater than the book value, then gain is on the disposal. Let's remember what book value is. Book value equals the equipment cost minus its accumulated depreciation. If the proceeds from the sale are less than the net book value, then we have a loss on the disposal. The best way to take a look at this is to do a couple of exercises. So the first thing we're going to do is we're going to turn to page 208, and we're going to take a look at exercise number 10. Number 10 says calculating gains and losses on disposal. Chris's Crispy Chicken sold one of its used deep fryers for $5,000. So right here we know we got cash of $5,000. The original cost of the fryer, so the cost of the fryer was $15,000, and then the accumulated depreciation that was associated with that fryer was $7,000. So with that information, they're asking us, can you determine if we had a gain or loss on the sale of this particular equipment? So the first thing we need to do is figure out the net book value. So we know the equipment was $15,000. We know that the accumulated depreciation was $7,000. We subtract the cost of the equipment minus the accumulated depreciation gives us $8,000 book value. We received cash of $5,000. So right here we see that the cash is less than the book value. So that means we have a loss of $3,000. Once we determine that, we can then prepare the journal entry. So the first thing we're going to do is we're going to take in the cash for $5,000 debit. We then need to remove the equipment off our books because we no longer have it. And that balance on our books was a $15,000 debit. So to remove it or bring it to zero, we would credit that $15,000. We also need to get rid of the accumulated depreciation that's associated with that asset. That would be a debit of $7,000 because accumulated depreciation is a credit balance account. And then we would need to record the loss on the sale, which in this case would be a $3,000 debit, making our debits and credits equal each side at $15,000. So this would then be the journal entry for the loss on the sale of this asset. They asked us, what would we have to sell this for to have no gain and no loss. We would have to sell it at exactly $8,000 if we wanted no gain and no loss, as that is the book value on this particular asset. Now let's go ahead and look at exercise number 11 on page 208. Exercise number 11 says record a disposal of this particular asset. It shows us the company sells a building with a cost of $350,000. So the building costs $350,000. And accumulated depreciation for that building was $270,000. So right here we can stop and we can determine that the book value of this particular building is 0, 0, 0, 0. Let's go ahead and do our math just like we were in class. The book value of this asset is $80,000. So right now we know we got cash of $70,000 for this particular asset. So therefore, if we got cash of $70,000, we know that we have a loss of $10,000 because the cash is less than the book value. So the recording of this transaction would be cash $70,000. The building would then be credited $350,000. We also know we need to get rid of the accumulated depreciation for $270,000, and then we would show the loss on the disposal of $10,000. When we do that, we equal $350,000 on this side and $350,000 on this side. So the part that's missing from A is the debit to accumulated depreciation for $270,000, as well as they took $80,000, which was the book value, away when they needed to credit building for $350,000. So A is wrong, where building should be $350,000, and they've left off the accumulated depreciation. What they did is they netted it out. That is incorrect. Okay, they netted out $350,000 minus $270,000 equals the book value of $80,000. They netted it out, and that journal entry is incorrect. They then go and say, what happens if we sold this item? Instead of $70,000, we sold it for $97,000. In that case, the book value is $80 minus the $97 gives us a gain of $17,000 because cash, in this case, is greater than the book value. So to record this transaction, we would have cash of $97,000. We would still have the same amount credited to the building of $350,000. Same amount going against the accumulated depreciation of $270,000. But in this case, we would have a gain of $17,000, which gives us $367,000 on this side and $367,000 on this side. I'm hoping that by the time you get to homework and you take a look at a couple of these examples, you will have practiced this by the time we get to class.